Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings. This time we're looking at Launch One Accession Corp. And unlike their name, their financial performance didn't exactly launch into the stratosphere. We're diving into their annual report, which is like reading a company's diary, but way less juicy and way more numbers. Launch One Accession Corp is what's called a blank check company, or a special purpose acquisition company that many know as SPAC. Think of it like a treasure chest with money, but no map. They're formed to merge with another company, and that's their whole purpose. They haven't done any business yet, just looking for a company to acquire. One thing that might affect their ability to make acquisitions is this set of rules for SPACs adopted in 2024. It's like new instructions for treasure hunting, and it might make things harder and more expensive. Launch One had their initial public offering IPO in July 2024, which is when they sold shares to the public to raise money. They raised $230 million by selling units for $10 each. That money is sitting in a trust account waiting to be used for this future acquisition. They have until July 15, 2026 to find a business to combine with. If they don't, the treasure chest gets emptied and shareholders get their money back, minus some fees. The team leading this hunt is made up of senior life sciences executives. They're trying to find unique opportunities in the healthcare or biotechnology industries using their know-how and connections. They hope to leverage their experience and relationships to find a good deal. Their plan is to find companies with unique products that aren't getting enough attention. When they're looking for a company, they want ones that are developing unique products, have promising data, are undervalued, have good management, and can benefit from being a public company. If they find a target, they'll do a thorough review. This means meetings, document checks, and looking at the company's finances. To actually make the acquisition, they might use cash, issue shares, borrow money, or some combination of these. It is essentially the same tools anyone would use when purchasing a company. The management team and board may have some conflicting interests as well. If they find a company that benefits them personally, they might be tempted to acquire it even if it's not the best deal for other shareholders. There is a chance the officers and directors might have to present good potential deals to other companies. They expect to find potential targets through their networks, investment banks, and maybe even get some unsolicited offers. They have about $230 million to work with. They hope this is enough to give a target company a good deal, maybe providing cash for growth or reducing debt. After they make the deal, they'll be entirely dependent on that one business they acquire. Unlike bigger companies, they can't spread their risk across different industries. Even though they'll try to assess the management of the company they acquire, they might not get it right. The new management might not be great at running a public company. Sometimes shareholders get a vote on the deal, sometimes not. It depends on the rules and how the deal is structured. There are certain rules like issuing too many shares or the management having a conflict of interest that trigger a shareholder vote. The team might buy shares to help get a deal approved or meet certain requirements, but they promise they won't use funds from the trust to do this. Shareholders have the right to redeem their shares to cash out. To prevent a few shareholders from holding the company hostage, there is a restriction limiting redemption rights. If they can't find a deal within the time limit, they'll return the money to shareholders. The warrants, which are like options to buy shares, will expire worthless. They're not alone in this hunt. Other SPACs, private equity firms, and companies are all looking for deals, so they're up against some tough competition. Right now, it's a small team. They don't have full-time employees yet, just a couple of officers working to find a deal. As a public company, they have to file reports with the SEC, including annual reports with audited financial statements. As a smaller reporting company, they don't have to include risk factors, but the following is a partial list of risks, uncertainties, and other factors that could have a material effect on us and our operations. There are a lot of things that could go wrong. They might not find a target, they might not be able to get financing, the target might not perform well, and so on. Political tensions and trade disputes could also make it harder to find a good target. They haven't made any money yet, they're just spending it on looking for a deal. The company had a net income of $5,119 and $529. That might sound good, but it's not what it seems. It's mostly from interest earned on the money sitting in the trust account, not from actually doing anything. They've spent about $400,000 on general and administrative costs. They don't have any major debts, just an agreement to pay the sponsor's affiliate $12,500 per month for office space. Now for the real test, the financial statements, we're looking for a few numbers that tell the real story. Here we see the cold hard numbers for the end of 2024. They have $850,338 in actual cash, but almost all assets are categorized as cash and investments held in trust account, or $235,529, $529,529, and $525,500. Then we can see a large negative amount at total shareholders deficit at section 9949 to 283, meaning there is more liabilities than assets. That doesn't look too good. Checking statement of operations lets us see what has happened during the reporting period. Most of the income came from their assets doing nothing. They earned $5,404,164 from interest, while also losing 400,000 tuan in administrative costs, resulting on a net income of 5,129. I will call that a victory, albeit a small one. The team owns a significant chunk of the company, so their interests are aligned with shareholders to some extent, but again, there may be conflicting interests. The board has determined that the independent directors are indeed independent, which is good for corporate governance. Now, what's my take? Launch One Acquisition Corp is basically a bet on their management team. They're hoping these guys can find a good company to acquire and create value for shareholders. The market is tough and there are lots of risks, but the team has experience. A significant weakness is their reliance on finding that one perfect deal. If that deal falls through, investors aren't left with much. The financial performance also shows that the company is not generating revenue, rather relying mostly on their cash on trust account to earn interest. The greatest opportunity lies on the company finding a real hidden gem and thus justifying its SPAC existence in the first place. It's a risky play, but with potentially high reward, though I'm not sure I would feel comfortable betting my own money in it. Thanks for watching, and make sure to like, comment and subscribe for more corporate deep dives.